All right, everyone. We're here live with David Jaffee. Is that correct? Is that how you pronounce it, Jaffee?
Yeah.
Of BestStockStrategy.com. David, uh, so I ran across you on my search, my never-ending quest to find out more information about stock options, and I just seem to have, I don't know, a kind of obsession about it. And I came across you after coming across many, many other um, stock option gurus online. I guess is the best way to describe them. And they all seem kind of shady to me. I think one of them actually said that, and you may get a laugh out of this, David, but one of them actually said that stock options are like penny stocks on steroids, and I
Mm.
I, I nearly had a stroke. Um, it there seems to be a lot of bad information about stock options out there, and then when I ran across your stuff on YouTube, um, I'm not gonna lie. At first, it kind of came across as the typical guru spiel, where I'm the best, I know everything, but you seem to also talk a lot of sense as well, David, and I kind of really appreciate that. So, what made you get into? I mean, obviously you're a stock options trader. You're kind of an expert on that. But what made you want to get into stock options teaching? I guess is the way to put it.
I think the primary reason was I left New York City and I was doing very well trading, and I've always been interested in the stock market. And I just got bored, and I thought that there was a way that I could do it while also helping people. So I just learned about like online marketing and things like that. And I know that that's kind of like a dirty word, but at the same time, you can be the absolute best trader. And if nobody knows about you, then there's no way that you're going to be able to help other people, because the visibility and the awareness is simply not going to be there. Then when I started getting into it, I realized how much shadiness there was in the industry. And going back to something that you said earlier, I definitely don't think I know everything. I think that that's impossible. And I'm actually kind of surprised that you picked up on some of the shadiness, because a lot of the people I say that they're like borderline sociopaths, where they study how to relate and build trust with other people. And they model their behavior in a way that earns people's trust before they screw them over. And with me, like, I'm very blunt. Like, it's pretty common where someone would email me and tell me their situation, and I'm just like, yeah, I don't think that you're a good fit, or no, I think you should spend your time actually getting a job, because you're not going to be able to turn $500 into like a million. Like, I'm just very blunt, and some people appreciate that, and other people don't.
Listen, I've always been a blunt person myself, and I totally feel you on that. I have made my fair share of enemies by being very blunt. So you live and learn, and that's really what I've learned is that you only really truly learn by living it. So when you say, "Oh, you were surprised that I could find some people being shady," I mean, you can imagine I've fucked up in my life, and I have definitely run into the wrong kind of people who have screwed me over. So it's you kind of have a nose for this thing, but you were a little different. Like at first, I thought I was sniffing you out. I thought maybe you were one of these gurus who was just going to start teaching me this basically this BS that you hear all the time about stock options, and then I started going through most of your videos, and
Mhm.
you seemed rather. I mean, you seem honest. You seem like you're selling a product. Obviously, you're selling beststockstrategy.com.
Mhm.
Um, but some of the strategies you talk about make sense, make perfect sense in terms of the stock option market, and in terms of uh, uh, the potential for profitability. So something didn't jive with me. So I just wanted to get on a chat with you. I wanted to call you and find out, what's up with you. There's a lot of people out there who will throw terminology at you, and they'll say, well, you can sell straddles or you can buy a strangle. If you buy a strangle, then your risk is defined, and your potential profits are unlimited. But at the same time, you're basically just throwing that money away when you're doing things like that. But you advocate for the exact opposite. In fact, you advocate for straight up naked puts, selling naked, straight up naked puts. Is that right?
Yeah, naked calls too during a bear market, but definitely, well, one, you never want to buy options because it's like buying lottery tickets. The way that people win is the insurance companies, they might not win on every single car that they choose to insure, not every policy, but when they spread out the risk by selling 100 policies or 200 policies, then that's how they make money based upon the spread. So they charge you a certain amount, and you're essentially, when you're selling options, you're turning yourself into an insurance company. You're turning yourself into a casino. And the people who say, and actually I made a video on this, that you're quote unquote picking up pennies in front of a railroad track, they just simply don't understand how options work because you don't have a choice. That is the only way, in my opinion, that you are going that you have any chance of being profitable as a retail trader above simply holding an SPY index.
Your philosophy is a lot like that of Tasty Trades, another very popular.
Yeah, yeah, it's very similar. Although I trade a lot less often, and whereas I don't know how deep down the rabbit hole you want to get, but they
Let's
pretty
go.
much, yeah, they pretty much scan based upon like liquidity, which means how deep the markets are.
Hmm.
So you want to, they look at the same type of companies that I trade, something like Amazon or Facebook or something where the difference between the bid ask spread, meaning like the price you can buy it at, and the ask being the price you can sell it at, that's probably only going to be like a few cents wide. So you're looking for those type of things because you don't want to experience a lot of slippage with every trade, meaning that if it's going to cost you like 10 cents and then to buy it, where I mean we sell, but let's say just for example purposes, you don't want to buy something and then the second that you take ownership of it, you could sell it for like 20 cents less. That means so you're looking for deep markets. But I think the biggest difference between myself and Tasty Trade is they usually encourage people to trade a lot and to trade often, and I don't like doing that at all. What I do is I will wait for a stock to correct. So let's say like something like Facebook, where I would look at its trading range over the recent like 2 or 3 weeks. And right now it's trading at around $165, around there. And I would say, okay, over the past 2 or 3 weeks, it's spent like 90% of its time between around $158 and around like 168, like something like that. Or actually, I think it's higher than 165. Maybe it's at like 168 right now. But then I would simply wait for Facebook to fall to the low end of its trading range, so around like 160. And then, yes, actually, it's at 172. It's had like a really good few days. So right now, it's at the high end of its range. And in that situation, you would not choose to sell a put because it's outside of its expected range. So because Facebook has pretty much been trading between around 158 and around like 170 over the past 2 or 3 weeks, that's where it's spent like 80 or 90% of its time. You would wait for Facebook to fall to around 160 on the low end of its range, and then you would sell a put for around and you would choose a price of around 145 or 148. What that means, yeah, and you would just choose based upon which price you feel comfortable buying that option at. So what you're doing is you're guaranteeing that even if Facebook falls down to 130, you would agree to buy Facebook at the strike price. And the strike price that we discussed earlier would be like 145 or like 148. And in exchange for agreeing to buy Facebook at 148, you would collect money. Let's say you'd collect $1.50 a share. So right now, Facebook is trading at around 172. You would wait for it to fall to around 160. Then you would agree to buy it at around 148. You would then collect money, like $1.20, $1.50, and in exchange, you would, if Facebook does not fall to $1.48 during the time of expiration, then you would end up just pocketing that money. It's just like you're selling insurance. If you sell a policy on a car and that car doesn't get into an accident, then 6 months later or a year later, that person pays you again. So that's how we get paid with our time. That's the most simplistic way that I could map it out.
I mean, it's a pretty simple explanation, but you don't get into things like deltas and thetas and extrinsic values and all that fun stuff. You focus solely on the stock price and the potential for profit. Like say, I guess the way you're going, it would be around a 70 to 80% probability of a profit.
Generally, it's higher. Now remember the probability of profits, they're always wrong, and that's
Yeah.
actually why we make money, because the implied volatility is always overstated. So if you have the implied volatility as saying that the probability of this being profitable is going to be like, let's say 75%, or one delta it would say 68%. The reality is the actual probability is going to be somewhere around like 72%. I do obviously look at extrinsic value, because extrinsic value is the time premium, and that's the arbitrage opportunity, is your extrinsic value relative to the amount of, let's say like if something was trading, that it's pretty much all extrinsic value. If we were going to sell like the 148 strike price, and we were going to sell a put on 160, when Facebook was trading at 160. I don't really look at deltas, although I usually try not to be too heavily weighted to one side, meaning like it's really hard to do, because usually I have a long bias, which is actually another criticism that I have of Tastyworks, where I believe that they actually usually have a short bias, so they'll sell calls, and then that usually ends up as a drag on your returns. Because even if you have a situation like we had in December, so in Tasty Trade, in their best situation, they would be able to mitigate some of the losses on their put positions by realizing 100% of their profit on the calls. But the problem is that in December, there were like 3 or 4 standard deviation moves where almost all of your existing put positions are showing like very large paper losses, where the gains, where you're keeping the premium from like selling the calls, it's almost inconsequential. It's just not even worth selling the calls unless you're in unless you're going to be in unless you know that you're in a protracted bear market. And we did sell calls in December, but at the same time, we had relatively large paper losses because of the put side, and it maybe mitigated our losses by about 20 or 30%. Really, the fact is that your best defense against like that type of situation like we had in December. Do you know what I'm going to say? Like what the best defense is?
Ooh, the best defense against a situation like we had in December, I would say, is probably. This probably isn't your answer, but I'm going to say the best defense is probably a vertical spread.
No, no, the best defense is, well, actually, that's not a bad. That's actually not bad. And the reason is because, yeah, you are. The problem with the vertical spreads, especially during a situation like December, is it's virtually going to be impossible for you to roll that position,
Oh yeah.
because the option prices are so high that you're going to have to take the loss. Yes, you paid for the insurance, and your losses are going to be a lot smaller depending upon how wide your spread is. But really, the best defense against a situation like we had in December is just to trade small, because I had a lot of paper losses in December, and I actually closed out a few trades for a loss. Like I closed out Alibaba and EA Sports for a decent loss, just because I needed to increase my buying power. But I made back most of the money in January, simply because I was able to trade small and then roll those positions forward. And then there was a massive volatility contraction in January, and I pretty much made back almost all that I lost in December. It kind of like screwed up my 2018 numbers, but I mean, who cares about that stuff? That's more just like accounting purposes. We were able to, like, December was stressful, but by staying small, you were able to overcome it in January.
Um, so what do you think about this market right now that we've been in? We've been in this brutal grind up that hasn't really seen a whole lot of range based trading. It's just been this bounce from the lows we hit in early January. How do you feel about this? Do you feel uneasy about it? Is it just annoying? Is it boring, or what is it for you?
Good question. Actually, I've probably traded less this week than any other time. I don't think no, I made one opening trade I made one opening trade today on Amazon. I sold a put because Amazon was down around $23. I got into that trade early, and I sold the put when Amazon was only down around 15 or 16. I really hate getting into trades early. I should have been more patient. And I actually told my subscribers that I need, I made a mistake because I could have been more patient and collected more premium. But I think it's a little bit boring, but at the same time, our existing positions are showing us massive profits as volatility contracts. I did, though, have a bad position on Boeing because I sold calls,
Ooh.
and Boeing increased like January 1st, it was trading around 305, around that. Maybe January 1st, it was trading a little higher, but after it reported earnings, it bumped up from like 360 or 355 to like 380, and then it hit a high, I think, of around like 446. And then I know over the past 2 or 3 days, it's gone down. I think right now it's below like 430. But yeah, like that was pretty brutal, and I had to flip that position. But I think this is fine. Like the way that the market is. I don't really like violent downturns or violent upswings, but as long if it's a slow grind up, or it's like a slow grind down, or even if there's like a one major sell off a week, then that's no problem. The stressful part is when you have like weeks where the market is down like 7 or 8%. Like that becomes very stressful. But if you have a week where the market's down like 2% and it's like steady like every week, that's no problem because you can just easily roll the positions and there's no stress in that.
I'm just looking at Boeing as you were speaking. I'm just amazed you can roll that off the top of your head. I do not spend that much time in front of stocks to know those numbers off the top of my head like that. And I got to tip my hat to you, sir. That was quite impressive.
Well,
Um,
here's the thing though, right? I have I have maybe like 10 or 12 or 15 stocks on my watch list. So I know pretty much, like, I mean, the reason why I didn't know Facebook off the top of my head is because um, I already discounted it, because once it exceeded 165, I stopped looking at it because I knew that there was no way I was going to trade it until it fell back to the low end of its range. But like, I only trade around 10 or 15 stocks. So if I don't know the trading range, then I'm not really doing my job, and I'm doing a disservice to my subscribers. Like, that's why they pay me. They pay me to be aware and to make good decisions.
so another difference between you and Tasty Trade is you stick to a small number of stocks that I would assume you know fairly well. You may not know all of the fundamental or technical analysis behind everything, and PE ratios and all that nonsense, but um, you seem to know these stocks pretty well in terms of how they move and how they fluctuate. Whereas with Tasty Trade, I mean, even today, Tom Sosnoff mentioned that he had something like 90 plus positions open on one of his accounts. So I can only imagine how difficult that must be to track and react to. That's got to be a benefit for you at least, because it does tend to keep your portfolio a lot simpler. But on the flip side to that, it's also got to be a little bit stressful when there are times of economic uncertainty, when you do have a smaller number of positions in your portfolio where they could be much more greatly affected by an overall economic downturn. How do you deal with that?
Yeah, that's a good question. And there's actually a lot there. There were two like major questions in there. So the answer to your latter question is that you want to have uncorrelated assets, but the major question, and I'll speak about that briefly. But first, I don't want to. I have tremendous respect for Tom Sosnoff. He's worth probably around 2 or 300 million dollars, and he's done a lot of good for the industry. When I email him, he emails me back.
Oh, he's a,
He's
he's a great guy. I'm not trying to badmouth him or anything. It's just I'm just trying to compare you two.
Yeah, I understand. I mean, I don't think I'll ever be worth a few hundred million. Plus, to be honest, I got out of doing like investment banking and like that type of thing, and I just don't have any interest in going back into like the corporate finance world. But in any case, there have been situations, and I hope if Tom watches this, he's not going to like get pissed off. But I've said it on YouTube before. There have been numerous situations where um, Tom has lost track of his positions, and I think it's completely admirable that he's mentioned that on the air, and he's had like no problem admitting that, because I think that they tell you that a human being can only keep around, what is it, like 7 ± 2, or maybe it's 9 ± 2 pieces of information in their short-term working memory at any one time. So I don't see how it's possible for anyone, especially if they're working full time or even if they're a full-time trader, to have 90 positions open, even if it's less, let's say 90 is excessive, like 40 positions open and actually keep track. It's just not feasible. Like you just easily become overwhelmed. And I think the most important aspect is just like in the information world that we're living in, where there's like terabytes of information created like every single second, the important aspect is to slim things down and to ignore everything that is not essential and that's not important. I never read articles about seeking alpha. I never watch TV, CNBC. I don't know, I don't know any like technical analysis or fundamental analysis. I think all technical analysis is BS. And I know that's controversial, but it is what it is. And I just figure that over the long run, prices are that they're pretty accurate and they're pretty efficient over the long run. Over the short term, they're not, and that's why you can have a situation where like Facebook is trading at like 218 in like July, and then in December it falls all the way down to around like what, like 122 or something. That's an inefficient marketplace in the short term. But I definitely think you need to trade a low number of securities, but you have to make sure that those are your A or A plus opportunities. So if you have an account that's like $100,000, I definitely believe that you should not trade any more than like three or a maximum of four securities. Now, if you have a great opportunity in one specific underlying stock, then it's completely okay for you to sell multiple expirations on that one underlying stock. So let's say if Amazon trades down to around 1620, right? Which it's not, but I think it's around. But let's say it trades down to 1620. You're like, this is a really good opportunity. I perceive this to be like an A minus opportunity or an A opportunity. You can sell in an expiration that's like 3 weeks out, 4 weeks out, 5 weeks out, 6 weeks out. You can ladder out your positions, but under no way should you have like positions on 10 different securities. And then going back to your last point that you mentioned about the concentration risk, I actually don't think that's accurate at all, because what you can do is you can have positions in different industries that are uncorrelated. So you can sell, if you're going to sell, I think it would be stupid to sell Amazon, Facebook, and Google. Instead, you should choose one, and then maybe you should choose between like a Lockheed Martin, Raytheon, or Boeing, because that's kind of like defense, even though Boeing is more like commercial. But you would choose one of those. Then you would choose a counter-cyclical play, like something like a McDonald's or like a Dollar General, which has relatively low beta, which means that it's not as sensitive to the moves in the S&P. So those would be like three industries. And then maybe you even want to trade like a commodity, like a GLD or something like that. So I think that's the best way of doing it, not spreading out, because what typically happens is if you're trading 15 securities, maybe three of them are like A opportunities, and the bottom five are going to be like C opportunities. And from my experience, the problematic trades are almost invariably the trades that you don't feel as good about. The A plus trades, those rarely ever give you problems. So why not put as much money as possible as long as they're uncorrelated?
I mean, it makes perfect sense. It makes me feel better about having a position that's currently in the money on GDX. So,
Oh yeah, GDX, it's actually corrected recently.
yeah, you know what? I got in at the wrong time. I should have waited, but what are you gonna do? I actually do have a question from the chat room. If you want to take a question there,
Yeah, of course.
yeah. Can you ask David if he uses any valuation techniques for the companies he trades, and if so, how he translates the results of his model to his trading?
Yeah, no, I don't use any of that stuff. It's all bullshit anyway. I mean, honestly, working as an investment banker, first of all, it's funny because I went to Cornell and then I thought I knew everything because I was like arrogant and I didn't know shit. And then they teach you how to do like this DCF analysis. And I can count the number of times on one hand that I use the DCF analysis in like a pitch book or for valuation purposes. So it's all done. All the valuation is really done like based upon comps, which means that you look at like your comparable companies. But here's like the dirty little trick: when an investment bank is selling a company, they will look at numbers and then back out numbers, and they can, I wouldn't say that they'll make the numbers say whatever they want, but there's a pretty good leeway. Like if something is trading at a valuation of, let's say like uh, let's say like 7 times, um, you know, I don't want to confuse people and get like too technical, but let's say it's trading at like one just metric. Let's say it's hypothetically 10. I can pretty much mess with the numbers based upon what my bosses want it to say, or I can mess with that number so that it's anywhere from like 8 to 12. So all that, I don't look at any of that shit. I just figure that, like I said earlier, that short term prices are, they tend to overreact and overcorrect, and long term, they tend to be a lot more efficient. Like, do I think it's efficient that Boeing went up from 300 to 446?
No.
And Boeing is like over $100 billion company, and it went up over 30, over like 33% in like a month and a half. No, but part of the reason why it did that is because it was trading at around 380, and then it crashed all the way down to like 300, and then it just retraced a lot of its gains. So you have to make sure that you trade small so that you can ride out the short-term losses. That way you can capitalize upon the long-term trend and the long-term stability.
So when you mention a lot of this stuff is bullshit, and I feel like a lot of it's bullshit too. I can't prove it. I'm not a smart guy. I'm just I'm just a schmuck who learns from the streets. But I hear numbers like I hear talk, especially about startups, about their valuations, or you hear about the market cap of companies, and I just sit back and I just think, well, who really gives a shit? Because it all feels like it's made up, and what I really care about is how I get my next meal at my dinner table.
Yeah, I mean the startup game and all that stuff. That I wouldn't say there's definitely some great companies out there, but one, a lot of the startups fail because, I mean, I kind of sound like Gary Vee now, but people are enamored with like the word entrepreneur. Everyone wants to be cool. But I can tell you the reason why, I work all the time. My life, like I live in a really nice place in Miami, but I don't take advantage of it. I work pretty much all the time, like 7 days a week. Like I'm fanatical. I'm a freaking workaholic. So it's not sexy like what I do. And the other thing is about like valuation, you have to be really careful because if someone's willing to pay you like $100 for 0.00001% of the company, then technically you can label that as a round, right? And then you can invert that at like an implied valuation of whatever that math works out to, like $10 billion or whatever it is, and you technically only raised like $100. So you have to be like super careful about that stuff. I don't invest in any like startups or anything like that. And the reason is I try to keep things as simple as possible. I don't invest in any IPOs either for the simple reason that the only way I trade is by getting comfortable with the recent trading range. And an IPO has no trading range. And also, I invest only in market leaders. And an IPO just simply doesn't have the trading history to be a market leader because it's usually like a younger company.
Which is an excellent statement. For me personally, I don't invest in IPOs, mostly because I'm a retail trader, so I'm not going to get in on the pre-IPO game. I can't afford to get in on that game. That's insanely expensive. But as a retail trader, I mean, from my point of view, IPOs are just me carrying the bag for the pre-IPO investors, and so it ends up tanking the stock eventually anyway. Then eventually, I could get in on that, but as a retailer, I cannot possibly see myself getting in on IPO. It seems like a really bad idea. I've yet to see in my lifetime an IPO really shoot and take off from day one. I don't think it's ever happened.
Yeah, no, I mean, it's happened. I don't think it's lasted. I mean, even Facebook, I think this was back in like 2011. I remember because I was actually in Colombia, and this was around like Hurricane Sandy time when Facebook was down around $20. And I think it IPO'd at around, I don't know, 35 or 40, something like that.
Hmm?
But I definitely think that buying IPOs is a huge mistake, primarily because they um, they have an over allocation. So they have warrants. The investment banks are able to hold warrants. So if let's say the open price is like 35, like that's the IPO price, they will hold warrants and then wait for the stock to pop up, and then they'll execute those warrants and then profit between between what the current market price is. Let's say it pops up to 50, and then they're able to buy it at like 35. So I would never buy IPOs. I think it's gambling. But look, man, a lot of people like gambling. They like the thrill. They just love it. Gives them a purpose. They feel like they're in control.
You know it. But here's the thing about gambling: you can't make money with it. Yeah, I mean, you can get lucky, and if you get lucky, hey, congratulations. But when it comes with gambling, you're not going to make a living with it. You're not gonna grind out a salary with that or anything. You're going to blow it all. You're going to blow all your money on the thrill. That
Yeah,
just
but yeah, and we live in an environment where like probably 70 or 80% of the people are addicted to pills. They're
uh,
fat, they eat shit food, they beat their wives, they're in debt. So I mean, are you expecting people to act rationally? It just doesn't happen. It's just the way that it is. And also, like, many people are self-delusional. So, or maybe they have good intentions, but with day trading, like you'll win maybe 40% of your trades, and then you'll get caught up in technical analysis, and then you'll say, "Oh, I win 40% of my trades. That's the expected outcome." Then they'll get super excited, and then they'll try to replicate the winning trade, quote unquote, not realizing that it's just the expected outcome. Like you're going to win 4 trades out of 10, and then they're going to get involved with like all these bullshit scanners and like charts and indicators, and then they're going to think that they can increase their win rate and their win percentage to like 60%, but it doesn't happen. So they waste their time, they waste their money, and they just act like a complete wreck emotionally, like they're a pinball.
see. That's one of the things I never really understood were the charts. Um, I have a very hard time reading. I mean, I understand what candlesticks are, and I know what the hell I'm looking at. But in terms of like technical analysis, and to me, it always just looked like people were just drawing lines and saying, "Well, that's going to predict the future somehow." And I've never understood that. It doesn't matter what guru was trying to sell me what bullshit. I've never gotten that. I
It's
don't grok it.
it's complete bullshit. It doesn't even make sense because the price, okay, if you take the price of Facebook, the way that it works out is the most important thing is, well, it's not the most important thing, but the price is supposed to be an indicator of the total market cap of the stock, meaning like the total value of the stock.
Hmm.
So if you wanted to buy Facebook, that, again, I don't want to get like too technical, but like
It's all right.
the equity value of it would be the market cap of the stock. Now, here's the problem though. So if Facebook 6 months ago was trading at around like 170, and then Facebook right now is trading at around like 170, like 172, they would have different market caps, meaning that you're not buying the same Facebook. And do you know why it would have a different market cap?
Why is that, David?
Because you have all these things going on under the scene, behind the scenes. You have stock buybacks, you have issuances, you have options exercises, all this stuff. So for an investor to own a stock of Facebook at $172 6 months ago, it's actually a different company because the structure is different. There's more shares outstanding, meaning that it could potentially dilute their earnings per share. So when people only focus on price, which is only what technical analysis does, I truly believe that like technical analysis, it's like a really good scam. Like there are people who are making like $5 or $10 million, but also I don't even think technical analysis and all that stuff and day trading is the biggest culprit of why people fail. I think that people fail because they just get greedy. I actually see it with options traders where there is a possibility that you can win 90% of your trades and you'll just get accustomed to winning. And you'll just say, "Oh, I win almost all my trades." And then you'll run into a situation like we had in like October of 2018, or I remember like February 5th through February 9th of 2018, or December of 2018, or like early January 2016, or August 2015. Like those are pretty much like the difficult periods that we've had over the past few years. And those people will just get slaughtered because they just get complacent, and they just trade too big and they're forced to close out their positions at a loss. And I mean, I'm not immune to that. Like in December, I had to close out Alibaba and EA Sports just because the the move down was so violent that I had to like accept giving up some profits,
Mhm.
just to just to make sure, because it's so for option sellers, it's so easy to make extra money as long as you don't get greedy and you don't trade too large.
And when you start trading too large, that's when you start eating into your account, and you end up with a margin call because you got exercised, and then it's game over.
Yeah, yeah,
Um,
you just fuck yourself up. And then the other thing is you should always during good times, like when the market is relatively stable, when like the VIX is under 15, you should always strive to make less money and build good habits so that you can lose less money during a time like October or a time like December. Because there's no way that you're not going to have paper losses as an option seller in October or December. It's virtually impossible because every existing position that you have that you sold, let's say you sold, going back to that 148 put on Facebook,
mhm.
let's say you sold that for, what do we say, $1.50.
$1.50,
If
yeah.
you run, if you run into a situation like we had in December, even if that contract doesn't get challenged, the volatility has increased so much, whereas the VIX would spike from like 15 to 36, that position that you sold for $1.50 right now is currently trading at $5. So the only option that you have, even if that contract and that position is not being challenged, is just to wait it out and to roll the position, reduce size, and reduce and lower the strike price. That's your only option. You just have to wait it out for some volatility contraction. But if you trade too big and you get greedy, then you're fucked. It's kind of like if if an insurance company is selling insurance and is selling hurricane insurance, and then there's a there's a warning that there's going to be a huge hurricane in like next week, and then you contact the insurance company and you're like, hey, I want to buy insurance and hurricane insurance for my house. They might not even sell it to you, or if they do, the premiums are probably going to be like 10 times more than they would normally based upon the probability.
So let's talk about good habits and good habits to form. Let's talk about that Facebook situation. Let's say you sold a put 148 put, and you brought in $1.50 a premium.
Mhm.
And then the volatility explodes, and it goes, from an IVR of 15 to, say, 21, 22, 30, who knows, and it's worth, that put option is now worth $5 instead of $1.50. So, you'd
Yeah,
be,
the VIX,
yeah.
the VIX, like the measure, because the implied volatility on that stock would probably be trading at, well, the implied volatility rank would probably be around 80 or 90 percentile in that situation,
Yeah.
probably even potentially more. But yeah,
Well, let's say you know what I'm saying. Let's say volatility explodes and the options are suddenly worth a shit ton more. What is a good habit in that situation? Is a good habit in that situation to do what your gut says and just wait it out, or is it greedy to sell another put because volatility is so high? Is that getting too big?
mm. Yeah, I think, well, one, I don't really know. I think the thing it's dependent upon is how much buying power you have. So you always want to keep at least 40% of your account in buying power because that acts as a safety net towards preventing bad situations like we had a few of them in December. So if you were going to tell me, oh, you have 90% buying power, where let's say you have a $100,000 account and you have like 90,000 available to trade, in that situation, I would say, yeah, like if the IVR of the stock explodes and you can collect a shitload of premium, then yeah, just take a shot. Because remember, with Amazon, it fell from like 2,000 and fell all the way down. I think like on December 24th or so, it fell all the way down to around 1,300 or around 1,320. That's a huge, for the largest company in the world. It had at one time like a market cap of like 1 trillion, and then it got cut all the way down to, I think, in like the high 500s or something like that, 500 billion or so, like the high 500s. But I think in general, when to answer your question, and everyone wants like absolutes, I think if the market is being very violent, your best your best action would be to not try to guess the bottom and to be conservative, to be scared, and to just wait for things to stabilize slightly. I think because the problem is that losses hurt a lot more than gains. So if you ended up selling a put on December 15th and then the market didn't turn around until December 24th, it's just not worth it emotionally. It's just way better. you can dabble. Maybe Amazon's trading at 1480 and you're like, holy shit, this is a great opportunity. I'm going to sell like a 1350 put. That's never going to be in the money. And then December 24th rolls around and you're like, holy shit, it's now in the money. And I'm showing like I'm showing a 300% loss on this. Then you're not going to be acting rationally unless you have a lot of buying power in reserve, and then you can say, okay, like I'm either going to wait it out or I'm going to roll it. In the worst case scenario, so okay, so to answer your question, in general, the best decision is when the market is tanking, you should pretty much just sit on your hands and wait for things to stabilize. I think the turnaround in December was like there was a Wednesday where the S&P was down like 100 points and then it like rallied mid-afternoon to it rallied like where it actually regained everything and then it closed up like 20 points. Like that was like a crazy day. The other thing is if you if you're in a situation where a lot of your positions are challenged, and I actually had to do this in February of 2018 because I was trading too big. I almost got caught. I got pretty lucky. Um, I just literally like rolled forward all my positions by like 8 months. So I remember I had like a really big like Boeing position. I had like a really big Facebook position, and I was able to roll forward my positions by like 8 to 12 months. And I literally like cut the number of contracts in half by rolling it. So that's one good thing about trading naked versus trading spreads. When you trade spreads, because you always have to roll forward that lower price put option, you are unable to benefit from the time premium. But when you trade naked, it gives you a lot more flexibility. Like there was a situation in February where I was short like 40 naked puts, and I was able to just push it forward by like 8 months, and I was able to reduce the strike price by about like $10 or $15 and cut the number of contracts in half. And then I just simply waited like 2 or 3 months until the implied volatility and the VIX decreased and volatility contracted, and then I just bought those back so that I didn't have the long tail risk. So to summarize, um, don't try to call the bottom when it's a very violent market like we had in October and also in December. And in the worst case scenario, you should just roll your positions forward, even if you have to roll them forward by like 8 or 12 months, because once volatility contracts, you'll be able to buy those back at a much lower price.
So would it be fair to say that trading is more about your ability to react to different situations and your mental capacity to handle those emotional swings than it is about anything majorly technical and complicated?
Well, I think the most important thing is that you have the right strategy because um, if I wasn't selling option premium, there's nothing I could do that I would make money. Nothing. Unless I was like working at an investment bank and I was like a transactional trader and I was profiting off like the bid ask spread differential. But as a retail trader, you don't have access to buying at the bid and selling it by being a market maker. So if you have the wrong strategy, then you're pretty much fucked because you can be the smartest guy in the world, but I mean, I read a study about day trading, which is pretty comprehensive. I think it was done by like Berkeley and in Taiwan, where they looked at the accounts of 360,000 people and 359,000 day traders out of 360,000 lost money, and the average loss was 15%. And the top 500 day traders, they only made 5% alpha, so 5% above, like just simply holding an SPY index and doing nothing. So if you have a shitty strategy, there's no way you're going to make money. But let's say you say, yeah, okay, I'm selling premium. Then I do definitely think that the most important thing, if you have the right strategy, is not getting greedy, and that's something that I've had to learn from experience. Um, like people should learn from my mistakes, and I'm completely open about them. Like even today with the alerts, I was like, shit, I sold Amazon too early. I should have been more patient. And I want to do that because I want to call myself out so that I continuously improve. Because trading doesn't have a destination. It's more like you're a traveler and you just become more efficient as a traveler as you walk down the path. There's no perfection.
There's if you have to understand that about being human, there's never anything near perfection, and if you don't accept that, then you're never really going to be successful in anything. You
Yeah, but
just
people dilute, they delude themselves. I live in Miami, and you would be shocked at how many people here buy like expensive cars and expensive clothes, and they can't afford it. that they can barely pay rent, and they just feel like they have to impress people. Um, but I'm not saying that you should be like me either. Like, I'm sure people think that I look like a homeless person, like I wear the same shit every day. Like, I just don't really care about that stuff.
Listen, man, I'm right there with you. I have been called a hobo by my fellow coworkers in the office because of the fact that I basically wear the same clothes every day because I don't feel like spending my money on lavish, expensive clothes that look really nice for a few months and then they get all raggedy and they're gonna cost me another $150 for a pair of jeans. I just don't want to do that.
Yeah,
Um,
and you have more important things to do than to decide and spend your time on what you should wear because so you're impressing people that you don't even give a shit about. And that was one of my criticisms of investment banking. Like I got called out for wearing the same shirt or it's just freaking bullshit. And then the funny thing is that my directors or my managing directors, they would be like alcoholics or they'd be doing drugs, or they'd have like multiple girlfriends or they'd be like freaking miserable. And me, like I'd never done like coke or anything like that, and they would like it's just because it's easy to pick on that because they see it, it's in your face. But God forbid these guys go to the bathroom and they're doing lines of coke, or they show up and they get drunk, or they're addicted to pills. Then okay, that's better because it's behind closed doors. It's freaking bullshit. You should be judged on your actions.
Unfortunately, you're not. You're judged on the person you appear to be, not the person that you are.
Exactly. Right, which is circling back to what we were speaking about earlier. That's how a lot of these great like fake gurus are able to manipulate attention because they know they know like
They know the lifestyle these people are seeking.
yeah, and they know how to build trust. They know where the levers are. They know how to like sell you out, but I just for me the most important thing is to like just respect myself and to be true to myself because even if I make like a lot of extra money, now I'm never going to work for free because then I would feel unappreciated. And plus, like I learn from my mistakes. I help other people make money. Like I deserve it, and because I help other people and I work really, really hard. So I don't subscribe to that bullshit. Like, oh, if you make so much money, then why are you selling courses? Well, the reason is that if I want to feel appreciated, and if I wasn't making money by teaching people, then everyone would take advantage of my time and monopolize it. I have no time to myself. And additionally, there would be no incentive for me to actually share my knowledge. Like, that's not how it works. This isn't like some type of altruistic shit. Like, you want to, like, why don't you go to a college and then say, hey, like, this is my situation, and can you give me free tuition? Like, no. And college doesn't teach you any monetizable skills, they teach you bullshit.
By the way, the study you were talking about from Berkeley, I believe it's a study across multiple colleges called "Do Individual Day Traders Make Money? Evidence from Taiwan," wherein the
Yeah.
abstract mentions
You
that.
look that up?
Yeah, I did. I was looking it up while we were speaking, and it says the abstract mentions that over 97% of all day trading activity is by individual investors, and more than 8 out of 10 day traders lose money. That's just the abstract. I don't have the exact numbers because it's a rather long paper, so I haven't been able to
No, it's
read the whole
actually
thing. But
what they said is yeah, 359,000. So 13% of the day traders make money on like 1 year, but consistently only 1,000 of only 1,000 of 360,000 are able to make money consistently. And the top 500, they make 5% alpha a year. I know it's like a long paper.
yeah,
Um, but yeah, but going back, like as far as like being a good trader, as long as you have a good strategy and you're able to not be greedy and really able to like manage your size, then that's fine. But realistically speaking, you have no choice because yeah, you can go on YouTube and everyone acts like they're like successful forex traders, but we all know it's bullshit. I mean, you should know it's bullshit because just the probability and the odds are completely against you. Forex is probably like the worst market to trade. So yeah, if you want to sell option premium, as long as you are able to like make good decisions and evaluate like an expected outcome, and that's really going to come with experience, then you should be able to be profitable.
I actually know of one person. This is the only person that I never personally spoke to him, but I did speak to one of his. I do speak to one of his students quite regularly. He's actually a pretty successful trader. Doesn't do stock options, but does do forex and does do stocks. Um, and the only person who I've ever seen be successful in forex is a guy called Mark Whistler. And do you know why he was successful?
Why?
He understood that when you use Bollinger Bands on charts, what you're looking at is actually just a standard deviation from mean. And once he put that together, he could basically bet based on those probabilities. So it all comes down to probabilities again. There was no magical technical analysis or anything like that. And I thought that
But let
was.
me ask you then. So if you're going to trade TA, why on earth, or you're going to day trade, why on earth, going back to the example that we've been using a lot about like Facebook. So Facebook right now is trading at like 178. Let's say Facebook drops, or 172. Let's say Facebook drops to 168. And then you're like, oh, okay, this is like a decent entry point. Why on earth, or even if it falls to 162, like we had, so we'll keep the prices consistent. What statistical advantage do you have at buying it at 168 when you can sell a put with a strike price of 148, collect premium, so that the net price of Facebook in the worst case scenario, even if you were assigned, which rarely ever happens, people definitely overestimate the probability of getting assigned, because as long as there's extrinsic value on the stock, they're not going to give you free money. But that's another discussion. But so let's say you collected $1.50 in premium for selling a 148 strike. Your net cost in the worst case would be 160, 146, 146.50. Why on earth would anyone want to day trade and buy it at 162 when they could potentially own it at 146.50? And that trade probably has like a 90% probability of not getting challenged, not giving you any headaches. You just make a good trade, have an entry point, and then you either wait for it to expire or you buy it back at around 50 or 65%, and then you just reallocate the capital. It just doesn't make any sense. It's just so simplistic when you just think it through like logically.
See, what you said to me makes sense, because that makes way more sense to me, and playing out the probabilities, which I can see and calculate, as opposed to trying to guess based on a chart. That makes way more sense to me than forex. And the whole point of my little story was that out of all of the people who have thrown money away in forex, in spot forex, I've known one guy who was successful at it. You know, it's
I think like two.
it's amazing.
I think the only person that I've ever met who was verified with forex was George Soros, where I think he like bet in like the late 80s or something about like the collapse of the British pound, or I don't know, something like that. I read it, I think, in like Market Wizards. But I mean, I just don't. Plus, with forex, you know that you have a massive counterparty risk, right? Like,
Huge.
there aren't. That means that the exchange that you trade in could just like magically go under, and you have no recourse. Like they could screw you over. It's not cleared through. There's just a massive conflict of interest, because the exchanges themselves, and I'm not like an expert on this, so I try to like stay in my lane. But from what I've heard, is that there is a conflict of interest, and your money is less protected when you trade forex, because the exchange is less regulated.
I don't even need to go into all of that. All I need to do is search for all of the various different forex brokers out there, spot forex brokers out there, and you'll find basically a graveyard of companies who have come and gone in years past, and that tells me everything I need to know. That if these brokers are going out of business, what business do I have putting my money in something like that? That's, to me, that's way too dangerous.
Yeah, and the worst part is they probably quote unquote went out of business, but
They
now
ran with
they're
them.
like living in like the Maldives or the Cayman Islands with innocent people's money who entrusted them, and then they just fucked them over.
Yeah, more than likely, which is why I don't. Which is why I just don't. I don't want to deal with that area of the market. Um,
And also, just real quick on that, if you're so interested in the forex market, then why don't you sell options on a currency ETF? That way you have better probabilities, because you're selling premium. So we're going back to that
mhm.
selling insurance. So you have the built-in probabilistic edge. So if you're so interested in trading forex, do it through an ETF where you sell puts and calls on it.
I think what happens with a lot of people, and it comes down to greed, David. I think this is my opinion, is that In spot forex, you don't need an account minimum. You can trade with as little as $100. When I say trade, I mean gamble. You can gamble away with as little as $100. Whereas with options to sell a naked call um, in any ETF basically, or in anything, you do need a substantial more amount of money than just $100. And I think that's what it comes down to is that mentality of, oh, I'm going to get rich doing this, and I'm going to get rich quick doing this, and it unfortunately it tends to burn a lot more people than it does help.
Yeah, because they have the mentality. I put out a video about this. What have those people done where they deserve to turn $500 into $1 million? Seriously, like why do they think they're buying lottery tickets and they're easy prey for scammers? And what have they done to deserve the right to make thousands of dollars or hundreds of thousands of percent off their money? So instead of learning a valid skill and a skill that they can monetize, instead they're just saying, okay, well, I only have $500. I'm unwilling to play the long game. I'm unwilling to be patient. I'm unwilling to invest in myself. So I'm just gonna use, like, I'm gonna trade forex with 100 to 1 leverage, and I don't think in the back of their minds that they actually expect it, because if you only have like $500, you really shouldn't be trading. Like, you're probably so used to like failing that your expectations are that this isn't going to work out. So it circles back and becomes like a their preconceived notions, and a lot of these people, they might have like very harmful or self-destructive tendencies. In a way, like, their preconceived notions are foreboding that they are actually going to fail, and I think part of them actually do want to fail, because there's no way that you can possibly be successful. It's just wishful thinking.
I think, well, I know you're not wrong. I know you're definitely right, but I think what those people are thinking is probably the same thing I was thinking, because I've been in that situation before where I was like, man, I got $500. I wish I could turn this into 5 million. I think a lot of it, honestly, is a desperation of the situation that they're in. Whether they're in a lot of debt, or they have a lot of things going on and a lot of responsibilities that, maybe they can't manage, or maybe they know, they're not going to put a meal on the table tomorrow night for themselves. I think a lot of that it comes down to a sense of desperation, because how, I mean, how often do you gamble, David? Do you play the Powerball or Mega Millions or anything
Never,
like that? Never?
never. No, but I've been in that situation that you're describing before, because when I was doing investment banking, I was also like very depressed. So I was taking like a lot of medication, and it's a very similar example, even though it's not with money. But I just went to a doctor, and um, I would just take like whatever they recommended, because I thought that these doctors have my best interest at heart. So if you substitute, so that was a very irrational decision. So instead of taking control over my own health, I was on like some very powerful medications, until I just got beat down so bad with them, and I had such negative side effects, that I realized that the only way I was possibly going to regain control of my life is if I did it myself, and I educated myself. So I'm no different. Like, I make mistakes all the time, and substituting what I was talking about just now for that situation, it's very comparable, because these people, they have $500, so they latch themselves onto a fake guru, which in my situation was like, the different doctors. They want a quick fix, which is very similar to me. Like, hey, I feel like shit, just make me feel better. So I'm gonna take a drug, and then they're gonna like get involved in some risky game, which is the same as like taking like antidepressants or things like that. And the outcome is invariably going to be, at least in my case, it was very bad. So then I had to pick myself up after wasting a lot of time, and just educate myself, and that's really what it comes down to. So you learn by experience, but now it's actually easier, because you have so much information at your fingertips. Whereas as long as you make good decisions by following the right people, you should be able to spend less time making mistakes, and you can learn from other people's mistakes, so that you don't repeat them.
David, it's been about an hour so far. How much more time can I steal from your life? Because I know you do have a family life you have to attend to.
Like 10 minutes.
10 more minutes? All right, then let me ask you this, since we've only got about 10 more minutes. You've dealt with mental health in your life. Do you have anything to say to people who deal with mental health issues in their life, and maybe they're struggling right now and they're not really sure that there's a light at the end of the tunnel? Do you have anything to any words of encouragement for those people?
No, I don't really have any encouragement because I think that extrinsic or external motivation is once they're watching this, and then at the end of that, they're still going to go back to their life, and maybe they're going to engage in like bad things because they feel, they're going to do like harmful things to themselves. I can tell you that health is wealth, and the most important thing, even more so than money, is your health, because if you're healthy, you can always make more money. Some of the things that I did, um, which are very controversial. I'm not a doctor, but there are a lot of things. I haven't been on any medications in like over 10 years. I take like high dose krill oil. I don't eat any sugars. I actually fast. I do cold showers so I can like immerse myself in I immerse myself in like ice water, like that guy like Wim Hof. I try to manage my stress, which I'm not very good at, but I try to do my best. I take a shitload of supplements. I also do things like I have an infrared sauna lamp where I actually shine it on my balls to increase testosterone levels. And I also use the infrared sauna to sweat. So I get the increased benefits of like the cold and then also the sauna. So that increases, it's just better for your immune system and also helps stimulate like dopamine and like acetylcholine and things like that. But I would say it probably took me around 3 or 4 years to get back even close to where I was like after I got sick. So it was a long process. So you have to make sure that you play the long game. And it's okay to do like two steps forward and one step back because that's how life is. And you shouldn't get discouraged or judge yourself when you're taking that step back. And I think that's one of the most important things, not to judge yourself and not to judge others. Because if I judged myself in 2009 compared with the person that I was in 2005, I would like feel like shit because I was in my early 20s and I was working as an investment banker. I was like very, very successful. And then I got sick when I was around like 24, 25. And I just didn't judge myself. I just had confidence that I would find a way to get better. So I think trying to always play the long game was very important because I would experiment with things and I spent a lot of money on supplements. Some things worked, some things didn't. I would listen to podcasts, I would watch YouTube videos, and I have a list of 10 or 15 things that I tried. Like I went to Columbia University and I had like intravenous ketamine, I had repetitive transcranial magnetic stimulation. So there's like a ton of shit that you could get done, especially if you live close to like a research study, like a place like in New York City, where a lot of your listeners are. And some of it's going to work and some of it's not. But I can tell you that as long as it doesn't hurt you, then you'll make progress and you'll get better.
David, I'm not gonna lie to you. I when I first contacted you, I thought you were gonna turn out to be just another one of those BS stock gurus who doesn't really know anything, but just wants to get about a few grand out of me and then drop me like a sack of bricks. But I don't know, man. You seem like a really honest dude, so I got to give it to you, man. Your best stock strategy on YouTube, beststockstrategy.com, David Jaffee. Thank you so much for being here. I really appreciate it.
Yeah, my pleasure. And if any of your listeners want to reach out to me, they can go to Best Stock Strategy, and then on the bottom, there's a contact form. I try to do my best to answer everyone pretty expeditiously. But then, I mean, if people ask me like too many questions, I'm like, hey, like, I'm sorry, I can't. I have like other things to do. But I am like very responsive, and I do my best to help people. And I don't like, I'm not perfect. Nobody is. But yeah, I appreciate you having me as a guest, and I hope that I added value and helped a few people with some of the things that they want to improve upon.
Well, you know what? Even if we didn't help them, we at least entertained them for a little bit. So, thanks again for your time,
For
man. I
sure.
appreciate it.
Uh, my pleasure. Take care. Bye.
Take care. Bye bye.